All right, welcome to another forex session. In this session, we'll also be looking at entries. Now, if you can see my screen, we are going to be looking for entry area in this chart. Okay. Now, I gave us steps. The first one is wait for some kind of a break of structure. Wait for a retracement in form of a chart pattern. Then at the break of that chart pattern that forms in form of retracement is your entry. If you see a big candlestick with body, or I'll say volume candlestick, or if you see a candlestick with obvious wick. Now, if you look at your chart, now, I told us to always trade with the trend. So the first thing you want to do is to check what's the trend. You can see this is a big consolidation market, but even in the midst of the consolidation, you also find that it's a bearish market. Sometimes you may have to go to a higher time frame to get the trend of the market so that you can look for your entries in a smaller time frame. So I always advise that if you want to trade 15 minutes, 30 minutes, 5 minutes, 1 hour, 30 minutes, trade with 4 hours trend. Trade in the direction of the 4 hours trend. Okay. If 4 hours trend is a bullish market, if you come to your 30 minutes, you should be looking for higher low, which is in direction with the 4 hours trend. Okay, if it's a bearish market, you should be looking for a lower high to trigger your trade. That's just a general concept. So there are other factors that you have to look at for to have a better entry. Now let's draw a structure. There's a structure here. You can see a structure that was broken. Okay. Now I can even put a structure here. Now this is my structure. Okay. I like the navy blue color. Now, the market, let's start from this point. Okay. The market broke out of this structure. This is a candlestick that broke the structure. This is a candlestick that broke the structure. Okay. I told us that the candlestick must be a candlestick with big body. Okay. Now, this candlestick, this particular one meets that requirement. Now, when the structure is broken, you don't enter. Okay. Like so many persons will enter in this particular candlestick. So many traders, this is their entry. Okay, I'm not saying that they are wrong, but it's not wise. But many times the market will break and fake you out. Like, okay, look at what happened here. This is a very big bullish engulfing candle. But you saw immediately after the break, the market came back. Okay, sometimes to avoid fake out, that is the reason why you have to follow this step I'm giving you. Now, look at this big bullish candle. So many persons have already entered this trade and look at what happened. But if you were keeping these rules I'm giving you, at the break of this candle, you check what is the next rule. The next rule is to look for a clear price action retracement. So I would have captured this market this way. This would have been my entry. At the break of this resistance, then retracement, just like what I explained in the previous video. Now, then I'll look for what? A big volume candle for my entry. Then my stop loss should be around this level. Let's assume that the market broke. But because we are following our rules by not entering into the market unless we see a clear break of the chart pattern that formed in the process of retracement. Until we see that play out, we will not enter into the market. Now, if you are following that through, you will see this fake out. This vertical resistance never broke. The market could not break it. Now, what will that tell you? That, okay, this market is not going to go to the upside because this structure did not break. Now, if you follow these rules, you will avoid fake out. The first one, locate the trend. The second one, you wait for a big candlestick to break. Now, after the break, patiently wait for a retracement. The retracement should form a chart pattern, end of the chart pattern. Then wait for that chart pattern to break. At the break of that chart pattern, you look for a candlestick with obvious weak rejection or a candlestick with body, big body, then you enter into the market. Now, the market faked people out, came back into what? The structure. Now, back to what I was saying. Now, this is, many traders will start entering to the market from this candle. But following the rules carefully, you remember that I told us in the previous 2 lectures that the retracement must form a chart pattern. At the break of the chart pattern, we wait for a candlestick with volume, with big body, or a obvious weak rejection candle. I know why I'm using the word obvious. It must be obvious, not something that look like doji. Okay, we'll talk more on this later. Now, this is our candlestick to break. This is retracement. Now, at the break of this retracement is the entry. That is why you must learn to always trap your price. Now, you can see a chart pattern forming here. I can call this maybe a wedge or a triangle. Like I told us, the name of the pattern is not as important as knowing what the market want to do or knowing the next step, the price action. Okay, that is the most important thing, not the name, but you can actually know the name. That is also good. Now, at the break of this vertical support, now this is my entry. This is the best entry, this candlestick. This is the best entry. The best entry, this is this candlestick. At the close of this candlestick is the best entry because it has met up to all the requirements. Break of structure, big candlestick to break, which is this. Clear retracement in form of a chart pattern, which is what happened here. This is another big candlestick to break. And retracement at the close of this candlestick is a clear confirmation. Then our stop loss can be around this level. Can put our stop loss around this level. Now, the reason why I always put my stop loss around this level is so that in case if the market want to still do some movement, some consolidation, at least I will not be stopped at. Now, this is what I normally do. I place my stop loss in a very logical area that if I am stopped at, meaning the market want to reverse, I don't get stopped at and the market continue to the direction I wanted it to go. No. Okay, that's why I said you must understand how to calculate position size so that no matter how wide your stop is, you will still be risking the same amount you intend risking, even if you are using a tight stop. Okay, now at the break of this structure, this is my entry candle. Okay, now let's move to another one. It's another structure. This is structure. And look at what the market did. The market broke out of this structure from this point. Now, this is the candlestick to break. Now, mind you, this is with the trend, so it's much easier to trade. Now, this is the candlestick that broke the structure and retrace. Now, so many persons will start joining the trend from this area. Now, if you join the trend from this area, and the market retrace, now you'll be on a drawdown during the process of retracement. And sometimes the market will break back into this area and continue to the upside. It happens all the time. Now, the trader that entered the market at this level and the trader that entered the market at this level, their profit margin will not be the same. The one that entered after a clear retracement always have more profit than the one that entered immediately, because the market can start retracing, and now when the market will start moving, instead of you to be making profit, you'll be gaining the money you have lost. Why the trader that just entered after the retracement has already started making profit. But because you entered too early, even though the market is moving to your favor, now you are now making the money you have lost before. Okay. Now, look at what happened here. The market came back to that same structure. Like I told us, that the market came back is not a criteria to enter into the market. We have to wait for that structure to be broken. Now, if you look at this market is forming so many kind of structure. Now, let's identify them. Okay, we can draw this. The market broke, retraced. Now, this could be your entry candle if you are working by this structure that the market formed, this price action, this chart pattern. This could be your entry. Now, this could also be your entry, this candlestick, because the market also broke a structure here. The market also broke and retraced. This could also be your entry. Now, either way, you are correct. That is why there's no one way to trade the market. Just learn to follow structure, learn to follow price action. You can see what the market did. Broke. Now, this is the best entry. This is the most logical entry. If you enter at this particular area, you are still correct, but this is the most logical entry. Then your stop level should be around this level. You can put your stop level around this level. Okay, then you can target 1:2, 1:3. Now, I'm not against targeting 1:4, 1:5, 1:6. Yes, it's very possible. But many a times, the market gives you 1:2 and 1:3. What I always advise traders is that target 1:2, 1:3. Once the market move, you can break even and target 1:5. Then you have nothing to risk. You are not risking anything in the trade. So it's possible. If you want to allow your trade to run to target 1:5, 1:6, 1:7, do well to break even and allow the market to do its thing. Okay, but don't get this mindset that all my trader must hit 1:5, 1:6. No, if you have a very good setup with 1:2, 1:3, you will be a highly profitable trader. A highly profitable trader. Okay, now that is another entry. Now, whenever the market retrace, you go back to the same process. Okay, the market retrace again to this level. Okay, let me draw another level. Now, this is another break of structure. It's another break of structure. It's a break of structure. The market broke the structure at this level. Market broke the structure at this level. This is a candlestick that They actually broke the structure. Okay. This is a candlestick that broke the structure. Now, of course, you saw the market moved. Now, no matter what the market is doing, keep to these rules. It always works. Now, some traders have already entered at this point. No, just see the market came down and retraced back. After every break of structure, there is always a retracement. It's just that sometimes we want the retracement to happen instantly. No. Now, this is 1 hour chart. Now you can see, okay, let's count the candlestick. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24. So almost 24 hours. It took the market 24 hours to retrace back to that structure. Now, this is where many traders has problem because they're patient to wait for 24 hours for the market to, they will just enter into the market. And before you know, immediately they enter into the market will start reversing. And before you know, fear will come into their mind and they will want to close the trade. And after closing the trade will start moving. Sometimes for 2-3 days, the market will keep trending to that same direction you wanted it to go. So the problem with traders is patience. You must learn to be patient. Learn to be patient because it is better for you to enter one trade in a week, and it should be a very logical and a very good trade than to enter 20 trades in a day and you're having series of losses. It will affect your psychology. Once you have 1, 2, 3, 4, 5, 6 losses, your psychology is already being messed up. So we must learn to have a strategy that works, and we must learn to keep it. Now, I'm showing us a strategy that works. This is a pure price action strategy. It works anytime, anywhere, any day. It works. Okay. Now, you can see the market did the retracement back to that same level. Of course, we're not going to enter the market because it retraced. We'll wait for what? For that break of structure. Now, you can see what happened. This is a chart pattern forming. You can see it. This is a chart pattern forming. Now, at the break of this structure, this is your entry. This is your entry candle. The best entry point. And your stop should be somewhere around this level. Your stop could be somewhere around this level. Okay? Now, this is how you approach the market. Okay, now, you see the reason why I say target 1:2, 1:3. Now, if you target 1:2, you're already out of the market at this point. And you are taking your profit. If you target 1:2, you're already out of the market. And what will you do again? You draw another structure and wait for a break. Why is another structure? Why other traders are waiting for 1:5? You are out of the market. You have taken your 1:2. You are waiting for another opportunity. Now look at what happened again. The market broke out. The same process broke out from this structure, big candlestick to break. Very important. Always remember that big candlestick to break. And the market retraced. You can see the retracement. What are you going to do? You come and you trap the price. As you can see what happened. At the break of that retracement is your entry. This is the best entry in this particular structure. This is the best entry. Okay. Now, I targeted 1:2 here. I've taken my profit. The trader that is targeting 1:5, the market has stopped him out, because remember, this is where our stop is. They have been stopped out. Okay. Why? I've taken my profit here. I've taken another profit of 1:2 again. Now, let's say I'm entering here. This is where my stop will be. If I'm entering from this level, my stop will be somewhere around here. Okay. Now, at this point is 1:2. I'm also out of the market. I have made 1:4. 2 from this market, 2 from this market. Why the trader that is targeting 1:5, 1:6 have lost his profit in this first trade, and there's no longer any profit. Now, look at what happened. Now, I'm out of the market at this level. The market retrace. Now, what will I do? I'll come and do the same thing. This is a break of structure. This is another break of structure. This particular candlestick is a break of structure. Now you can see the same retracement, the same thing is being played out at this point. Now, what are you going to do? You draw the structure again. At the break of this structure, this is another entry. Now, the trader that is targeting 1:5 entered from this point. Now, if he could stay in the market to this level, he has made that 1:5. Okay. Now, I entered from this level. I've made 1:2. The market retraced. I joined again. I have still made the same 1:5 that he made. But I make mine in a safer way, because this same thing that played out in this first place can also play out again. Remember, he lost the trade here. I did not lose it because I took my profit out, and I've been taking profit all this while. Okay, so this is how you follow up your trade. Now look at another one again. This thing keep playing every time. It keep playing every time. The market is all about break of structure and retest. Break of structure and retest. Your entry, break of structure. So this is how you follow the market, okay? All right, I want to end this lecture here. I just hope that we actually get to understand what entry is all about. It's a very simple aspect of forex. Just follow these guidelines I'm giving you in these lectures. The repetition of this is what happens in the market every day. The market does not do any other thing apart from impulse move retracement. As the break of structure, retracement, the market continue the same thing. Impulse move retracement, whether bullish, whether bearish market, these things always happen in the market. It always happens. So narrow your mind to this concept that my entry is at the break of some kind of structure, retracement in form of chart pattern, at the break of that vertical or horizontal or support and resistance, at the break of it, big candlestick to confirm the signs of buyers and sellers in the market, or obvious, a candlestick with obvious weak rejection. As at the appearance of that candlestick is my entry. It's a very simple concept. Now we're going to take more examples, because I believe this is the most simplest aspect of forex. So you should get this out of the way so that you can focus on other delicate areas of forex. Okay, so thank you very much for your time. We'll do more analysis as we get going in this course. Okay, remember, go through your chart, practice this, create a demo account. Even if you are a trader currently, just leave your live account for now and master these things on a demo account, so that you can correct all your errors from a demo account before you move into a live account. All right, happy trading. Bye.